A quiet shift of power is happening behind the scenes of global finance, and almost nobody outside institutional circles is talking about it. Right now, one Wall Street figure, not a president, not a senator, not a central banker, may be influencing two of the most powerful economic decision-makers in the United States. And if this influence plays out the way many insiders suspect, it could either help safeguard your wealth or quietly erode it over time. If you want to understand who might be shaping the financial environment you live and invest in, there's one name you need to know: Stanley Druckenmiller. He isn't a household name. He rarely seeks headlines. But within elite investing circles, he's considered one of the most respected macro investors of the modern era. And what makes this moment so important is not just his track record. It's who learned directly under him. Two individuals now positioned near the very center of U.S. economic policy are widely described as having deep professional and intellectual ties to Druckenmiller. Kevin Warsh has been discussed as a potential Federal Reserve leader, and Scott Bessent has been associated with senior Treasury leadership. Both men are reported to have spent significant portions of their careers influenced by Druckenmiller's macro investment philosophy. Why does that matter? Because together, the Federal Reserve and the U.S. Treasury effectively control the financial oxygen of the entire economy. The Federal Reserve determines interest rates, manages liquidity, and influences the cost of borrowing across nearly every corner of society. The Treasury manages government spending, taxation frameworks, and how the United States finances its national debt. Those two institutions don't just impact Wall Street. They shape mortgage payments, credit card rates, business expansion costs, job growth, retirement accounts, and the long-term strength of the dollar itself. Traditionally, the Fed and Treasury operate with different objectives and occasionally opposing pressures. That separation acts as a balancing mechanism. But when leaders at both institutions share similar training, mentorship, and macroeconomic instincts, the system can begin moving with greater alignment. Alignment can create stability, but it can also amplify risk if both sides lean toward the same policy direction at the same time. Now, this isn't about conspiracy theories or secret control rooms. Influence in finance rarely works that way. It's far more subtle. Mentorship shapes how leaders interpret data, how they respond under crisis pressure, and what risks they consider acceptable. And in this case, the relationships being described are not casual industry connections. They are portrayed as long-standing, deeply professional partnerships. Scott Bessent is often connected back to Druckenmiller through earlier hedge fund operations and macro trading environments. Kevin Warsh has reportedly spent years inside Druckenmiller's investment ecosystem, studying how global macro investors analyze interest rate cycles, currency movements, and liquidity flows. Many insiders describe these relationships as formative, almost educational blueprints that shaped how both men understand economic decision-making. That brings us to the real question investors should be asking. What happens when the individuals controlling America's monetary and fiscal engines operate from a similar strategic playbook? To answer that, you first need to understand the philosophy behind Druckenmiller's success. Unlike traditional stock pickers, Druckenmiller built his reputation as a global macro strategist. He studies entire economic systems rather than individual companies. His approach focuses on how interest rates, currency strength, government policy, debt cycles, and liquidity interact across global markets. He became widely recognized during his time working alongside George Soros, particularly during the legendary 1992 trade against the British pound. That trade famously forced Britain to withdraw from its currency peg and generated massive profits. But the trade itself wasn't luck. It was a calculated bet that government policy and economic reality were on a collision course. That type of thinking defines Druckenmiller's framework. He looks for structural imbalances, moments where policy direction conflicts with market forces, and positions capital ahead of those turning points. Another defining characteristic of his strategy is adaptability. He is known for aggressively changing his market stance when new data contradicts his previous view. In trading, that flexibility is a powerful advantage. But in public policy, where consistency and credibility are critical, rapid shifts can introduce uncertainty into financial markets. And uncertainty is something markets historically punish quickly. Druckenmiller has also been extremely vocal about two major economic risks: long-term inflation pressures and the expanding U.S. national debt. He has frequently warned that unchecked government borrowing could eventually force policymakers into extremely difficult decisions. At times, he has referenced the aggressive anti-inflation policies of the early 1980s, when Federal Reserve Chairman Paul Volcker dramatically raised interest rates to stabilize the dollar and crush inflation. That period restored currency credibility, but it also triggered deep economic stress and sharp declines in risk assets. If future policy leaders influenced by Druckenmiller lean toward protecting currency stability at all costs, markets could face periods of tighter liquidity, higher real interest rates, and increased volatility across stocks and speculative assets. On the other hand, if they prioritize growth and financial stability through easier monetary and fiscal policy, the result could be rising inflation pressure, a weaker dollar, and stronger performance in commodities and hard assets. Both directions create winners and losers, and markets dislike uncertainty more than almost anything else. Let's take a closer look at the individuals frequently connected to this discussion. Kevin Warsh previously served as a Federal Reserve governor during the 2008 financial crisis. During that period, he operated at the intersection between central bank policy and financial market stability. Over time, he became known for expressing concerns about prolonged money creation, excessive quantitative easing, and the long-term distortions that ultra-low interest rates can produce. After leaving the Fed, Warsh reportedly spent years working inside Druckenmiller's investment structure. That experience exposed him directly to how institutional investors interpret policy signals and reposition capital in real time. That type of exposure often changes how policymakers anticipate second-order economic effects. Scott Bessent, often associated with Treasury leadership discussions, is similarly described as having deep hedge fund roots. Treasury officials manage government debt issuance, bond market communication, and fiscal strategy. Those responsibilities directly influence Treasury yields, which serve as the benchmark interest rates for mortgages, business loans, and consumer credit nationwide. If Treasury leadership operates with a trader's sensitivity to market psychology, they may prioritize avoiding sudden financial shocks. However, avoiding short-term market pain can sometimes allow long-term structural risks to grow quietly beneath the surface. One policy direction often discussed in this context involves maintaining a relatively weaker U.S. dollar to support exports and ease debt burdens. But a weaker dollar can simultaneously increase commodity prices and raise import costs, which can feed inflation. This is why investors must stop thinking in simple good versus bad policy narratives. Every macro decision redistributes economic advantage somewhere else. Now here is the real lesson investors can take from studying Druckenmiller's career. His success rests on three core principles. First, always analyze the macro environment before selecting individual investments. Interest rates, liquidity conditions, and currency strength shape asset performance far more than most investors realize. Second, be willing to change your view when new data emerges. Emotional attachment to investment ideas destroys long-term performance. Markets reward adaptability, not stubbornness. Third, prioritize risk management above everything else. Druckenmiller is known for making large, high-conviction trades, but only when risk is carefully defined. Surviving market downturns is what allows capital to compound during favorable cycles. Now let's translate these concepts into possible market scenarios. If interest rates begin declining significantly, growth-oriented sectors often outperform. Technology companies, early-stage innovators, and smaller firms that depend heavily on borrowing tend to benefit from cheaper capital. Liquidity-driven investment themes frequently reemerge in lower-rate environments. But if policymakers adopt aggressive anti-inflation strategies involving higher real interest rates and tighter liquidity, markets historically shift toward defensive positioning. Companies with strong balance sheets, stable cash flows, and pricing power tend to outperform during those conditions. There is also a third strategy many institutional investors adopt during uncertain transitions: the barbell approach. That involves holding a combination of defensive assets, high-quality growth investments, real assets like commodities or precious metals, and maintaining liquidity reserves to capitalize on volatility-driven opportunities. The most important action investors should take right now isn't chasing specific stocks. It's learning to watch signals. Pay attention to early policy speeches. Monitor Federal Reserve communication about inflation and liquidity. Watch how Treasury officials describe debt management and bond market stability. And most importantly, observe how policymakers react when economic data surprises expectations. Behavior patterns reveal far more than isolated headlines. If policy leadership influenced by macro trading frameworks begins reacting faster to economic data, markets could experience increased volatility and faster trend reversals. If leadership emphasizes long-term institutional stability, transitions may unfold more gradually. Either environment rewards investors who stay flexible and disciplined. Because long-term investing success rarely comes from correctly predicting a single event. It comes from building a system that adapts across economic regimes. Personally, the strongest portfolios are never built on one economic narrative being permanently correct. They are built on diversification, risk planning, and structured decision-making processes that account for both success and failure scenarios. If the balance of power between monetary and fiscal policy begins shifting toward tighter coordination and shared economic philosophy, the coming years could produce rapid market rotations and policy-driven volatility. Volatility punishes investors who guess blindly, but for prepared investors, volatility creates opportunity. For those who want to study institutional-level market frameworks, portfolio construction strategies, and real-time investment decision models, structured investment education programs exist that break down these systems step by step. These programs typically provide research methodologies, macro-analysis techniques, and examples of how professional investors position capital during major economic transitions. But regardless of the specific resources you choose, the most important factor is participation combined with disciplined strategy. Financial systems evolve constantly. Wealth tends to accumulate among those who understand policy shifts early and position themselves thoughtfully. And if this emerging alignment of economic leadership truly represents a new chapter in U.S. financial policy, the investors who pay attention now may have a significant advantage as the next market cycle unfolds.